Hello, and welcome back to another episode of IG's Trading the Markets podcast. Today, we're going to be talking about the tech sector in China because it's just over a year since we saw that crackdown in Chinese tech companies, and we kind of want to reflect back on what we've seen over the last year and what we're currently seeing at the moment in the market with all the volatility that's been going on. Joining me today is Brendan Ahern and Xiaolin Chen from Kraneshares, who actually offer an ETF on Chinese internet companies under the ticker KWBPLN, which you can find on the IG Investors platform. Brendan, Xiaolin, welcome. First of all, I just want to get your views quickly on what we're seeing currently in this industry, in the Chinese tech industry, in the market, all this volatility we're seeing. What's your opinion on this?
Over the last year, Daniela, we've seen a selling in the underlying securities that we hold within KWeb, driven by really the sum of all fears that investors have been very concerned about China's implementation of regulation of the internet companies. We have the SEC, the US regulator, articulating how they're going to enforce the Holding Foreign Companies Accountable Act, which could lead to a delisting of US listed Chinese ADRs in 2024. And then I think more recently, we've seen the Ukrainian crisis, the sanctions applied to Russia, the fears that similar sanctions could be applied to China. So really, you have all of this fear, all of this negativity has really weighed on the space. And yet, more recently, we've seen some significant catalysts, which have certainly led to some volatility, but this time to the upside.
Brendan, you were talking just there about regulation and how the SEC is going to enforce this Holding Foreign Companies Accountable Act. Can you give potentially a little bit of insight into what that means exactly? What other regulation we have potentially from the Chinese government, how this affects these big stock companies that are affected mostly by this?
Well, for 10 years, the US regulators and Chinese regulators have been talking about allowing US listed Chinese companies' auditor to provide their audit reviews to the Public Company Accounting Oversight Board, the PCOB, because the lack of progress. A US law was signed in December of 2020, which said that if these companies' auditors don't start providing those audit reviews, then beginning in 2024, they could be delisted. Now, many of the Chinese companies have relisted in Hong Kong, allowing institutional investors such as us at Kraneshares to migrate our position out of the US ADRs into the Hong Kong equivalent. So at Kraneshares, we've taken this law very, very seriously. As fiduciaries, stewards of our investors' capital, we've moved KWeb significantly to the Hong Kong share classes, just in case. We're still optimistic the two sides resolve this, but we're going to take the more conservative path, and so we've taken these steps to protect our shareholders. At the same time, we've had a very significant statement recently by Vice Premier Liu He, really talking about resolving this. And I think for investors, Xiaolin, it could be worth maybe, I think for some foreign investors, Western investors, the prominence of Liu He, what he said, it really is a game changer. But I don't know if really his status, his importance is necessarily recognized by all Western investors.
Yeah, I want to quickly also try and get a bit more macro and fundamental here because it's not just China right now. We're seeing a lot of volatility in the market. You were mentioning earlier what's happening in Eastern Europe and how that affects. How can you potentially see these macro and geopolitical events specifically affecting the Chinese tech sector? I mean, we've seen the share prices in this sector, and we'll have a look specifically at some of those in a second, dropping for the last 12, 14 months. What's the impact that you've seen specifically of what's going on at the moment geopolitically have an impact on these companies?
I can take that question, Daniel. Very, very interesting to note is Chinese equities or Chinese companies tend to have very limited overseas exposures. So if you look at their percentage of revenue for the companies that's from China, that has the revenue generated outside of China is in the single digits. Not saying they don't have the exposure, they have very limited exposure to overseas exposures. So if any external factor impacts overall revenue streams on Chinese equity, going to be limited. The other point is the foreign ownership that is owning the Chinese stocks today is at the very low end. It's somewhere around 4.5% of the Chinese equity onshore is owned by foreigners. So that means if you start to, do a bit of a risk, reverse a bit of a conservative approach to retrieve from equities, is highly unlikely to going to impact China's onshore equities as the ownership is really low. And on top of all of that is today the active managers are still at a stance of underweight Chinese equities. If you look at the, the data shows that in the wind or in Bloomberg, that the active managers are still underweight China versus their benchmark by almost 450 basis points. That's quite a significant underweight position off there. And the geopolitical tensions has caused probably two direct impact with China. Is one, energy prices and the wheat, the food component that potentially that can impact China's CPI. On the wheat front, this the corn and particularly that part import that China import from outside of the world is very limited. This is lessons learned by them in 2015, 2016, when they had a huge reliance on importing from externals on wheat and corn. They realized that's not stable. So they removed and potentially have a self-sufficiency domestically to deal with any import needs on the food front. So wheat import from China, including from Ukraine and all the rest of the world, is limited to 4% only. Very limited, import needs from external. On the energy front, the CPI basket, the inflation basket of China, has a very low percentage that is in the energy, somewhere around 2 to 3%. Even if energy shoot up, government has a few ways to either subsidize or using some other ways to manage and control the potential impact on inflations. And in many ways, we do think the spillover effect on geopolitical tensions on China's domestic economy from the macro perspective is going to be quite limited.
Great. There was some really, really interesting points there you were just mentioning. I just want to quickly pick up, you were talking there about the CPI and how it has a very low percentage in energy. What is the biggest weight on inflation in the Chinese economy? If someone that's interested in trading and investing in China and whether it's Chinese tech or any other sector in the Chinese economy, what are they looking out for if they're specifically focusing on inflation and how it affects the share prices?
It's such a great point, Daniela. It's very important to understand in China is if you look at the cross-sector tradings today in China, it's kind of highly correlated over the last 12 to 13 months. If you look at the cross sectors trading, that indicate macro factor is driving the price returns. In this instance, you got to understand the macro side or the policy side, what is set by the government. In fact, this year, the government has said what is they are looking at or what they are trying to achieve for this year at the NPC meeting. That stands for National People's Congress. That is the most important meeting for the government or for the year. That's for investors to understand, like you and I have a New Year resolution. This is the Chinese government's agenda for this year. They have said it very clearly. They expect GDP, this is set by Premier Li, said the GDP target at 5.5%. Almost a percentage higher than the street's estimates. That indicate the government will do whatever it takes in terms of policy to be accommodative, supportive for the economy to continue to grow. This is in line with the Bank of China, PBOC's statement, or they made the statement in the January's conference. They said, monetary, fiscal policy will stay accommodative. This is reassurance by the Premier Li at the NPC. The other things is they also, confirmed the commitment of finding 11 million new jobs for this year. They have many graduates, they have migrants, they have all these people, they need to find new jobs every year. This year, they need to find 11 million new jobs for the people. And I remember this, seeing Brandon's China last night. Brandon wrote a blog called China Last Night, that stable get mentioned 76 times by Premier League. Let's just indicate last year, you've seen the whole year of reform regulation introduced. Those you can safely assume now this is behind us. Now let's focus on how we can implement and make sure the economy or the country grown at a stable range. Obviously the inflation get mentioned, is the target is get mentioned, unemployment rate get mentioned. All those are not surprised, but GDP is surprised the market is higher end, and the commitments for the government and policymaker to support the economy also comes at very welcomed by the investor.
Great. Let's talk more specifically now about the ETF your Kraneshares provides, the CSI Chinese, the China Internet Index. Looking at the holdings, it's not surprising to see that the biggest holdings are Alibaba, Tencent, Baidu, the big tech companies that everyone's heard of, and especially when we had these regulation clampdowns, were especially the ones that everyone was focusing on. If we're looking at their current charts, and I mean, you can put up Alibaba or Tencent as an example, we saw those highs in the charts, whether it be at the end of 2020 for Alibaba, Tencent, it was more towards the beginning of 2021. But we've seen a steady drop since then, potentially nothing too dramatic in terms of daily volatility, but we have seen a steady drop, a bearish momentum in these share prices, hitting those lows that we saw at the beginning of March. And now they seem to have slowly reversed to the upside. What can you tell us about the share price specifically that are taking part of this fund? How are you seeing this valuation? What do you think is behind this bounce that we've seen over the last 2 weeks? What are your views on this?
Well, I think you have this sum of all fears, all of these negative factors that have weighed on investors' sentiment to the individual stocks. That many of these issues have led investors to come out of the stocks indiscriminate of the fundamentals of the companies. That if you're worried about a company being delisted, you don't care what price you want, you just want out. And I think we've seen this excessive pessimism, this probability of all the negatives coming to fruition when we got this very significant rebound recently, really driven by the Vice Premier Liu He saying that they want to solve the Holding Foreign Companies Accountable Act, and that certainly decreases the probability of a delisting. And so you saw this very significant rally, and it's our belief that in the coming days and weeks, we'll see tangible follow-ups from the China side on fulfilling that statement of resolving the Holding Foreign Companies Accountable Act. And the companies are at extreme valuation discounts. That in the case of many of these stocks, their forward-looking price to earnings ratios are 2 standard deviations below their 5-year average, and that's even after the significant rally. So we think that if we can get some good news in the space, you're going to see investors come off the sidelines. And there's talk about how this idea that China could somehow be sanctioned like Russia. That's we're seeing verbiage backing away from that. And certainly the potential resolution of Holding Foreign Companies Accountable Act, another significant catalyst, as well as Vice Premier Liu He's speech spoke about really backing off on China's internet regulations. So really, really the 3 primary drivers in weakness in the space, we're seeing signs of positive outcomes, and that will bring investors back off the sidelines. And I think we're just seeing the very first beginnings of that process.
Right. So just to sum it all up and finish off this podcast, it seems there by what you were mentioning, those 3 main catalysts you have, just to confirm the outlook for the Chinese internet tech sector, you're seeing some positive momentum heading into the next few months?
It's our belief that many of these issues are very much resolvable. And it's certainly not only in the best interest of China, but certainly in the best interest for the U.S. to resolve HFCAA. And again, you have all this pessimism baked in that's really weighed on the space. And if we get some rays of sunshine, some green shoots, I think there's more upside to come. 100%.
Well, thank you very much, Brendan and Xiaolin, for joining me on IG's Trading the Market podcast. And to all our investors, remember you can find Kraneshares China Tech Fund on the IG Investments website. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.